Ladies and gentlemen of the Market Open, I would like to start off today's show by playing a bit of poetry. And this poetry should describe my feelings as a Google shareholder yesterday and should also describe the feelings of Sundar Pichai as he talked on the earnings call and watched his stock fall tens of billions of dollars in valuation. This is the poetry that I would like to start off the Market Open with.
On the tables or what?
Oh, yeah. I ain't gonna lie, I'm getting cooked. I'm getting cooked. I'm getting cooked. I ain't gonna lie, I'm getting cooked.
I ain't gonna lie, I'm getting cooked. Okay, that is the poetry we need to start off this Market Open with if we're talking about Google, because that is the debacle we saw with Google stock today. And quite frankly, Elon Musk probably had the same poetry. I ain't gonna lie, I'm getting cooked when the Delaware decision came out. And Lisa Su probably had the same feeling when she gave out guidance for AMD. I ain't gonna lie, I'm getting cooked. The only person that didn't say they were getting cooked, and the person that actually had the excitement on an earnings call you would expect from a CEO who's not getting cooked, but who is doing the cooking himself, is Satya Nadella. And so that's what we're going to talk about today, folks. We got Google earnings, we got Microsoft earnings, we got AMD earnings, we got Starbucks earnings, we got new jobs data, we got the jobs report we have to discuss. We have Powell speaking at 2:30, going to be making a Fed decision on if we raise, cut, or pause rates. I'll be covering that at about 2:25 p.m. Eastern Standard Time. I'll be live, and we'll see what Powell has to say and analyze every little smirk or frown he gives. And then on top of that, we've got a ton of more macroeconomic data coming out in regards to where the economy is going, how the economy is doing. And really, today's Market Open is going to be very important because you've got macro data coming in, but you've also got these big tech earnings yesterday that were okay, not horrible. And you've got three more companies that are going to do earnings this week that are very important: Apple, Amazon, and Meta. All of that is going to coincide to see where is February ultimately going to go for the stock market. So we got a lot to discuss today. Sethi Roth, Adrian, Theo, David, Nick Piercy, Victor, Miss Yiger, Miami Ren, Mr. Seymour, Duck, Midwest, Tabor, Sanjay, Jeff, Franz Baker, Steph, Martin, Cows, Mariah Singh, June, Frederick, good morning from Germany. Awesome. We got Germany in the house. Albert, Irwin, Darpan, Inbound, Jacquees, Noodler, Lena, good morning from the DMV. I love the DMV. Except when I have to go to the DMV, even though I got my license renewed this time without doing it. It was online, so it was actually a good process. But I remember 5 years ago, that was not a fun day. Cows, Steph, thank you all for being here today. All right, let's get into it, and let's discuss what's going on in the broader equity markets. We got Kelly in the chat saying that I should be the Google CEO. I've got the brown part figured out. I don't have the come up with Google Chrome in like 2007 part figured out, because people forget Sundar Pichai came up with Google Chrome. And Google Chrome runs most of their advertising because most of the advertising happens through search and a lot of it happens through Chrome. So he definitely deserves the position. But after the earnings call yesterday, I had some thoughts on if he deserves to keep the position, given he's had it for 5 years. And I have some thoughts to say about Google. So we'll talk about that later today. Erwin says, life update, starting a new job. That's amazing. Let's actually start a new segment on the channel in terms of these like little things we do in the chat. We have Where Are You Calling From? Let's do life updates. We'll do it once every 2 weeks. So if you have a major life update, put it in the chat. My life update is that I'm about to get cooked on my Google options as soon as the market opens, and you guys will see that live. So that is my major life update. But outside of that, I'm just kidding. Put a life update in the chat. We'll do the first segment, and then we'll get to the comments and go through life updates. All right. So Google and Microsoft is a little bit more time we have to spend on that topic. So I think we'll start off with Elon Musk and what's going on with Tesla. We'll start off with that topic first, then we'll get into macro. We've got a lot of macro news to discuss, and then we will keep going from there. So I think let's start off with the news that's really hot off the press, which is this Elon Musk situation. Apparently, Elon Musk had a compensation package that was worth $55 billion, and that compensation package, which is why Tesla is down. How much is Tesla down right now? It was down 5% yesterday after hours. Tesla's down 2.8% at 186 right now. It was at 182 yesterday. That compensation package got canceled by the Supreme Court, essentially, of Delaware, right? The court in Delaware that most startups are incorporated at. If you have a startup, you incorporate in Delaware. The reason for this is not only for tax laws, But it's much more friendlier when it comes to just doing business operations. It's the only state in the country that does this. All the big ones, Facebook, Google, they all have a bunch of subsidiaries, but they're all incorporated in Delaware. And for some reason, Elon got sued by a shareholder that apparently had 9 shares. And the rumor is he was shorting Tesla, so he lost a lot of money, but he did also have 9 shares. And as a result of having his 9 shares and suing Elon for excessive compensation, the judge in Delaware somehow said that Elon Musk's compensation package was excessive, and she denied him the $55 billion pay package. So Elon went from being a 200 billionaire to a 155 billionaire. So yes, like poor Elon, we get it, but still, that's kind of insane. For all of that was in stock and options, kind of disappeared overnight, and now they have to come up with a new executive compensation package. Now, that doesn't mean he's going to have a dramatically lower amount than 55 billion, but what it does mean is that the company is going to have to spend time, energy, and resources in reevaluating how to compensate Elon Musk. They're going to have to figure out how to potentially give him these voting shares, this 25% of voting shares that he wants. Maybe he sacrifices some of the money to get some bargaining power on the voting shares. So technically, this could be a blessing in disguise. But it does mean that 5 years after the electric car maker's co-founder was granted the largest executive compensation in history, by the way, he got this because he 20x'd the stock. Otherwise, he wouldn't have gotten the 55 billion. You know, he slept on the factories in order to make that 20x happen for shareholders. I have no idea, and I haven't read through the entire thing, but I have no idea how the judge came to this decision and ended up doing this. Elon was not happy about this. He said, never incorporate your company in the state of Delaware. He had a poll last night saying, hey, I want to, relocate the company from Delaware to Texas. He's upset about this. He's not necessarily happy. Here's 45 seconds of Dan Ives giving his thoughts and opinions on this, and then we'll keep going into the coverage on this and try to discuss why this is ultimately happening to Elon.
That the package was just excessive. Elon has gone back to his board and said, no, I need more stock in this company in order for you to keep my brain power. Where do you come down on this?
I mean, the biggest asset in Tesla is Musk. Musk is Tesla. Tesla is Musk. And obviously, this is a jaw dropper that came down in Delaware. I think the board ultimately goes back to the drawing board and comes out with a comp package that could supersede this and maybe get Musk to what we believe could be close to 25%, voting interest. It's a pivotal time for Tesla, and the board is not going to take this sitting down. This is something they're going to fight. And I think it could actually be an aha moment for Musk and the board.
Investor plaintiffs argue.
Now, the other thing that's really interesting about this is a great tweet by Sawyer right here. What's ironic in all of this is that the 2018 compensation package was approved by 73% of Tesla shareholders at the time. This was before Tesla 20X. The package also couldn't be gained by Elon. He had to hit extremely difficult market cap and revenue milestones. And then if he did hit those tough targets, he couldn't sell the shares from the package for 5 years once exercised. Elon only did well if shareholders did well. The incentives were well aligned. Tesla stock is up 10x since 2018. Compensation package was announced and revenue is up 9x. I mean, now granted, in 2020, we had the greatest liquidity event in history in regards to printing $7 trillion. So yes, and everyone getting stimulus checks and the stock market finally having retail investors join it with Robinhood adding 23 million investors. So there was a lot of stuff that happened for Elon to 10x the stock. Maybe some of it, dare I say, was detached from the fundamentals of Tesla. But the stock went up, right? So he deserved whatever happened. You can't blame him. He did what he had to do and he got the stock to go up. So for this compensation package to go away, and no one can deny how much work Elon works harder than all of us combined. He is the epitome of hard work. It's hard to realize that. It's hard to imagine how this Delaware Supreme Court essentially came up with this decision. So, I'm looking forward to getting juicier into these details and seeing what the justification is, but Tesla shareholders are up 10x. I don't understand how, since the deal was approved, I don't understand how the compensation is excessive. And if this compensation is excessive, I wonder, other CEOs and their compensation structure, why that's not excessive, given, maybe it's not 55 billion, but they also haven't 10x their stock. So there's a good justification, in my opinion, for what's happening with Elon. Martin says Tesla needs new lawyers. Maybe they do, because losing this case, every shareholder thought this was like a BS case. There was no way this was going to happen, and it ended up happening. And Elon ended up messing this up. Alexander King in the chat says, you did it again. You said more friendlier. You need to fix your grammar before you pursue starting a business. You know what? You're right. We gotta get Grammarly embedded into my soul. Maybe Neuralink and the chips can help. before we try to, do anything in the world. We gotta get the grammar right. But nonetheless, I mean, this is a tough situation for Elon, and it's not going to be friendly towards him in terms of the new compensation package he comes up with, because that's going to have to approved. That's going to have to get approved by Delaware, unless they do a switcheroo and they get it unincorporated in Delaware and they do it in Texas, which is probably more friendlier. But I don't know how much legal work they would have to go through to do that. I mean, that would be tough as well, and it's just more instability on the stock. Oh, wow. I didn't know this. This judge was the same one that made Elon buy Twitter. Wow. I did not know that. This judge was the same one that made Elon buy Twitter. That actually makes sense, because that dispute was resolved in none other than Delaware, because Twitter was incorporated in Delaware. Every startup is incorporated in Delaware. And then the startup becomes a big company and they just stay in Delaware. Tesla stock down 2.7%. So this judge seems like they definitely have a thing out for Elon if they made him buy Twitter, because honestly, he had a good reason to not buy Twitter. I mean, like, I know people say he was, full of BS, but like, he found out there were more bots than when he made the offer. When he made the offer for $44 billion, he assumed there were 230 million users. Then Twitter came up to him and was like, well, 5% were bots. And by the way, people forget about this. Twitter made a report like 20 days after their Q3 2022 earnings came out, and said 5% of our daily active users for the past 3 years have been wrong, because when you switch in and out of your accounts, if you have multiple like burner accounts on Twitter, like if you have the accounts on your phone, they count that as an active account, even if you didn't log into it, even if you didn't switch between the accounts, which means that there was at least tens of millions of accounts that were just fake, that were just not real, that were not on the numbers that shareholders thought were real users that were not users. So Elon had a good argument to pull out, in my opinion. I mean, he had a really good argument, and even if it was, him trying to cover his ass, that Delaware judge not granting it to him probably means that judge does not enjoy Elon Musk's behaviors. So that was a tough situation for Elon, and we'll see what happens in the future, but not good for Tesla shareholders right now. 186, 2.7%. We thought the dip would get, we thought the dip did get eaten up yesterday. It ballooned to 194, now down to 186 in the pre-markets, and we'll see what happens as we get in. Elon had a terrible argument. He just didn't want to pay the $2 billion breakup fee. I'm not saying the argument was phenomenal, but I'm saying he did have an argument. Like, if I was his lawyer, I would have, maybe I still would have lost the case, but I would have been like, dude, they were lying to us. I made an offer to buy a company, and we find out they were not lying to us. They were lying to the entire public. So like, yeah, maybe I don't want to buy them anymore. And so I don't know. It's something that you could reasonably see going his way, but that judge just did not want to do it. Okay, let's do the quick life updates I said in the chat, and then we'll go to Google and Microsoft. So Dan is on vacation skiing in Park City, Utah with the fam, but got to get my market updates in. Dan, thank you for joining. That's awesome. I love that you're skiing. I've never been skiing. I've been snowboarding once when I was like 10 years old, and that's it. Broccoli says I have no life, so no updates. Okay, that's fair. Benny, life update, just got a 12% pay raise. That's awesome. 12% pay raise. That's not bad at all. Okay, there we go. Got some nice life updates in the chat. 12% pay raise is not bad at all. Victor says, what a heck board is going to fight just because of money. Yeah, and at the end of the day, look, the board, I think, is going to be able to fundamentally re-alter his plan. The problem is, I don't know if the board's re-altering of the plan is going to include the compensation that he wants and the 25% voting shares. And until that happens, Tesla shareholders are stuck in limbo. Let's hear from Dan Ives on Microsoft and Google, and then we'll get into our coverage on those two stocks, and then we'll talk about AMD as well.
So of the Mag 7, you've got Tesla, Alphabet, Microsoft. With these mixed results, you had some coming in with higher EPS, but just barely meeting expectations on revenue. The group hitting a high going into earnings. Were they just priced to perfection? With us tonight, widely followed tech analyst Dan Ives, Wedbush Securities Managing Director. Thank you for being here in studio. I gather you didn't think that there was anything mixed about those reports. You think they just hit it out of the park.
I think for Microsoft, I mean, that's a quarter and a press release that you should print off and put in the Louvre.
Why?
Because if you look at the AI revolution, what's happening, they beat by 300 bips on cloud. Copilot, it's exploding from a use case perspective. And they gave guidance. Even the bulls didn't think that they were going to give. I think the most important earnings throughout all of earnings season, regardless of sector, is Microsoft. This shows the AI revolution is here. Monetization is actually starting.
There you're seeing the extended hours trading down more than 5% at this point. So what are investors not liking about this? What are you seeing that they're not seeing, Dan?
I think it's a continued Groundhog Day that we've seen post Microsoft quarters, the knee-jerk reaction. But then if you understand what's really happened with monetization, this is an incremental $1 trillion of value. I think it's a pound table for this thing to be down. I ultimately view over the next 3, 6, 9 months, I think there's going to be a $4 trillion market cap.
All right. So why is Dan so bullish? Couple reasons for this on Microsoft, and then we'll talk about the catastrophe that was the Google earnings call. So Copilot is growing phenomenally, and so is the cloud. The cloud, Azure Cloud, is growing at 30% year over year, which is just phenomenal for that business. I think they brought in $25 billion of revenue, growing at 30% year over year. Google, on comparison, brought in $9 billion of revenue, and they only brought in 800. Look at this stat. Google brought in $9 billion of revenue, 864 million of profit on the cloud. Microsoft brought in 25 billion of revenue and 12.5 billion of net income on the cloud. So, I mean, Google is like at a 10% operating margin on the cloud. Microsoft's at almost 50%, which is just absolutely incredible. So the cloud growth is amazing. You've got GitHub Copilot subscribers. Remember, Microsoft owns GitHub that they acquired them a year ago, or 2 years ago now, for I think about 7.5 billion, 30% up year over year. Copilot is an incremental $10 a user a month, which implies Copilot alone is now a $156 million annual recurring revenue business. And the question here is, how long is it until that's a $1 billion annual recurring revenue business? Now, remember, Copilot is Microsoft's basically AI companion that they attach to Word, PowerPoint, Excel. All the Office users are going to be able to upgrade for $30 a month to Copilot. GitHub is something that they own, which is what a lot of the coders use. I mean, like if you're in programming, GitHub is everything, right? It is where you pull code, you extract code, all that stuff. And to code in a much more AI efficient way, you've got Copilot for $10 a month. Most people are going to pay for that. That's not that much money. And if you have massive scale, I mean, that is just going to keep growing and growing and growing. And we're seeing the numbers. This is not fake. This is not 1999 type of numbers, 30% quarter over quarter, not even year over year on GitHub Copilot. So you've got the cloud that's growing incredibly well. You've got, Copilot subscribers that's going incredibly well. Ryan, we'll talk about the Paramount Global offer in a second, because that's some big news as well. We got a lot of news today. And then you've got Satya Nadella. I listened to both calls yesterday on the channel, and Satya Nadella sounded excited. He sounded like someone that understood what was going on. He sounded like he knew where their roadmap is. He sounded like he understood the trajectory of the AI. I mean, he sounded like he had a pep in his step, and the guy's been doing this for a while, and, he's worth billions of dollars, but he still sounded like he's hungry and he wants to keep winning. And so from that perspective, Microsoft killed it. Now, the stock is down a little bit simply because the valuation has gotten very, very high, and Microsoft's going to have to prove even more growth to get the stock to go higher. Right now, down about 0.72%. So it's down 1% because obviously the stock's run up 33% in the past couple months, but it's not down like Google, 5.76%, giving up 2-3 weeks of gains because they missed on one metric that we'll talk about in a second. But that's why Microsoft is doing well right now. Imnop says Microsoft has Copilot on my computer right now, but no way I would pay for it for personal use. Yeah, the good thing about Copilot is they're not going for consumers. They're going for the enterprise, because all the money in AI is in the enterprise. So they're going to Walmart and they're saying, hey, Walmart, you have 3 million people that are doing white collar jobs. Do you want all of them, or 50% of them, or 20% of them to pay this extra $30 a month? And Walmart would be like, yeah, it'll make them more efficient, all this stuff. But ChatGPT is the consumer facing application, which there's really no money in, because you're losing money off the consumers. Because ironically, the more you use ChatGPT, the less profitable you are to OpenAI, because there's a computational cost towards every query you type in. The input token and the output token cost them money and cost them Azure credits. So, I mean, it's same thing with Spotify. The more you listen to music, the less profitable it is for Spotify to run as a business. They actually want you to subscribe and be engage enough to not cancel your subscription, but also not listen to that much music that it costs, because it costs them more money. The enterprise version of that product, though, when you're getting that flat subscription, is a lot better. So that is where their growth is going to be. And if that growth continues to happen, then Microsoft's going to be able to do very well. Now, let's move on to Google. Google, again, for those that missed it, we got 600 people here. I played this when we had about 140 people here. This is the little bit of poetry I just want to play that describes how I felt yesterday during the earnings call and how Sundar Pichai probably felt during the earnings call as well. Let's listen to this beautiful set of poetry describing what happened with Google yesterday.
Oh, yeah. I ain't gonna lie, I'm getting cooked.
Sundar Pichai was asked one question. Okay. One question that mattered. The question was, hey, and the guy he wasn't even so explicit. If I was an analyst, I would have been like, so is ChatGPT taking your lunch? Like I would have just asked that, and then they would have never invited me to an earnings call again. But the guy was like, so there's other things that are competing for people's attention on search. What is, how do you plan to deal with that? Basically saying, what the hell are you going to do about ChatGPT? Like, is this an existential threat or not? And I kid you not, Sundar's answer was just like, we're very excited for AI. There's a lot of things that we're competing with, and 2024 is going to be an exciting year. And it was the most non-responsive answer I've ever seen from a CEO. I never thought that I would be on the bandwagon of like, get Sundar out of here as CEO. But that answer right there made me so less confident in my conviction in Google. Now, granted, the stock selling off was stupid. And like, we'll talk about all the bull cases for why this is a meaningful buy the dip, especially if it gets down to that 135 range. But that answer was just like, dude, just say that, yeah, we're a little bit behind on GPT, but we're catching up, and generative AI is helping our search, and LLMs are making our search product even better. And we get 88 billion visits a month. Bing gets 1 billion visits a month. So like they said we were going to come to the dance, and like, they're not even part of the running for prom king or prom queen. Like, this is what's going on. We're Big Daddy Google right now. I would have said if I was the CEO, we're Big Daddy Google. Sundar probably is less explicit with his vernacular, but nonetheless, it was a bad answer. It was a very bad answer. Okay. And so that was the problem with Google. Now, in terms of their actual business, let me pull up a graphic right here that kind of shows why they had a phenomenal quarter, in my opinion. And the reason it's down for for the people wondering, well, why is the stock down? It's not because the earnings call, is because they missed on advertising revenue by 420 million. So the market expected 65.94 billion in revenue. Google brought in 0.6% less. They brought in 65.52. A random analyst came up with the argument that they would bring in 65.59. They come in at 65.52. And that's the reason the stock is down. Now, their free cash flow also took a little bit of a hit because they had to pay some more taxes. So that didn't meet expectations. But I don't think that's a reason to tank the stock as badly as the street tanked it. And we'll see, if it recovers this morning or not. It doesn't look like that in the pre-markets. But to me, that's a meaningful dip. That is not an existential problem with Google. YouTube hit $9 billion of revenue for the first time. It's up 16% year over year. Their search business is up 13% year over year, 48 billion. I mean, to grow 13% with like ChatGPT trying to kill you is pretty impressive to me. Google Cloud is up 26% year over year. Not as much as Microsoft, definitely not as profitable as Microsoft, but still that's doing well. The growth rate went from declining to accelerating. Google Play up 23% year over year. And then they made $800 million off some other bets that they did. $86 billion in revenue. They did $60 billion in buybacks, and they're probably going to etch that towards 65 to 70 billion in 2024. Their EPS did very well in terms of increasing, obviously, because of those buybacks. They beat on EPS, they beat on revenue. The one thing they missed on was that advertising number. Now, the bear case here is that if you're an advertising behemoth and you are the ones that everyone has to mess with when it comes to advertising, why are you missing that core metric? It's kind of like Netflix subscribers. That is their core metric that they can't miss on. And, in 2022, they missed on it badly, and the street, tanked the stock 50, 70%. If you're Google, you can't miss on advertising if like you're saying to the market that AI is helping your advertising get better, which I think they did a good job in the beginning of the call, basically saying AI is making your advertising so much more personal and recommendable, and like it's getting more efficient. The problem was if better, well, that's not the best thing in the world. So that's why Google got cooked, and that's why Google took a little bit of a beating, and we'll see, how it continues to go into the future. This is the Google position I have that I'll share as soon as the market opens, and we'll look at how badly it gets cooked, because I think it's going to get cooked. So last night we ended the position up about 30% right here. So we're up about 2,500. This can, if Google gets to 225 by January 2026, this will be about a $40,000 position. It'll be about 32,000 in profit. But I think today this $13 a spread, this is probably going to $9 in my opinion, which means I'll be down $1,000. So, now granted, I have 2 years for this to recover, so it's not the worst thing in the world, but it's kind of annoying because this has already been dead money for the past couple months as Google's been in the gutter. And I didn't really DCA into these. I have a decent average at 991, but I didn't feel like DCAing into this. I thought Google will be fine, and then Google kind of shit the bed on earnings. So we'll see how that position turns out, but that is why Google really did not do that well today. And so that's the issue with the Google. Now, in the context of AMD, which also took a massive beating, and then we'll get into the macro and talk about the jobs report. That was actually very bullish that came out today. AMD is down 4%. They're down at $164. There's one paragraph for why AMD is down, and it's at the very end of this press release, which is on their guidance. Okay, so their guidance is pretty bad. Let me just pull up that paragraph right here. They basically said everything's going to decline or stay flat, and you kind of have to deal with it. So for the first quarter of 2024, AMD expects revenue to be approximately $5.4 billion. This is down from $6.1 billion this quarter. Sequentially, AMD expects data center revenue to be flat. That's not good. With a seasonal decline in server sales offset by a strong data center GPU ramp. That's not good. Client embedded and gaming segment sales are expected to decline sequentially. That's not good. With semi-custom revenue expected to decline by a significant double-digit percentage. That's not good. So you got all that guidance coming from AMD that tanked NVIDIA yesterday, and not really tanked, but it definitely brought it down a little bit after hours. NVIDIA now is down 2% in the pre-market, so that's a little bit rougher on NVIDIA. That is why we're seeing some of the semi companies have some issues given NVIDIA's guidance was not the best. It is potentially warning, is NVIDIA's guidance not going to live up to the, at this point, almost 35% increase over the past 4 months that has happened in the stock. And, you know, I mean, analysts are projecting NVIDIA is still going to show triple-digit growth and it's going to be amazing. But if there's any sign of weakness here in NVIDIA, given what AMD's demand look like, and I know AMD is a different company than NVIDIA, I get it, I understand GPU demand is fundamentally different than CPU demand, and NVIDIA has more software margins, AMD has hardware margins. But if there is weakness, it's not going to be good for NVIDIA. Not going to be good for NVIDIA at all. So that's the problem. Philip says, gutter, Google was just at all-time highs. No, I'm talking about, you know, I bought the spreads back in September, and then Google was basically stuck from 120 to 137 for a good 3 months until December. It didn't even break out in December. It broke out last week. It finally got to 150. So, and that's when the options became more profitable. But it's, you know, it's been stuck from 120 to 130. Now, granted, we had an opportunity to buy Google at 85.95. I get it. So we had time to DCA into them. Didn't really buy too much during that time. But one could argue Google's PE is already at 25. After today's drop, it might go down to 23. Google will have the lowest PE out of the Mag 7. And they just brought in $85 billion of cash, $307 billion in revenue per year. They did about $80 billion in profits this year. And they just have incredible free cash flow, and they're doing incredible amounts of buybacks. Now, in terms of employees, they went only from 190 to 182. So they cut 8,000 employees last year, which you could argue is a lot, but Zuck's cut 20,000 employees. And I think that is where they may find some opportunity to decrease CapEx and increase their EPS, even though they don't really need to do that dramatically because they're doing all these buybacks. So I don't know if getting rid of employees is the answer. To me, there's a more fundamental problem at Google, which is that when 92% of your revenue is advertising, you're not innovating enough. You're just not taking enough risks. And, you know, I on a valuation perspective, I like Google, but on a fundamental level, I don't like Google at all. Because what is there to Google other than advertising? Like, I would pick Microsoft over Google any day of the week. Any day of the week. When it comes to a fundamental kind of qualitative assessment of the companies and the frameworks for how you would think about their long-term growth. But on a valuation perspective, I can't buy Microsoft. I'm not buying it at $3 trillion. I'm just like, I missed the boat on Microsoft. It's whatever. But Google at $1.3 trillion to me, 1.4, 1.5, that's very cheap given the pure numbers that's coming out of Google. The question is, will investors overlook the potential flaws in the fact that they're just not innovating anymore? So we'll see what happens. But that is what's going on right now with Google, Microsoft, and AMD. 99 says my like was number 70. Thank you for liking. If you guys could like the stream, that would mean the world to me, and it would help out a lot. All right, so let's go to the macro. Let's talk about what's going on in the macro and keep going from there. By the way, what time did everyone wake up today? I woke up at 4:30 and I slept at 12. I didn't really want to wake up at 4:30, but something just woke me up at 4:30. I don't really know what it was, but I just got up. And then I got to work, started finishing my newsletter, just getting into a bunch of different things that I had to do. So what time did you guys wake up today? And why did you wake up at the time that you woke up? That is the question of the day. All right, so here is the job report, and I'll get to your answers in a second. This is a very bullish job report, and this was really exciting. We had 107,000 jobs versus 150,000 jobs expected. This was bullish. The reason for this is because if we have less jobs available, there's less pressure on wages because there is less competition for those jobs, there's more competition for those jobs. So if Deloitte is offering 90 grand to be a consultant and you've got 20 people applying for it, those 20 people are not going to be able to say, hey, Deloitte, give me 105 or else I'm going to go to the next person, because Deloitte's going to be like, okay, go ahead, because the next person's not offering you a job. So it's either us or you don't have a job. And that is what creates less inflation on wages. The problem since 2020, when we had that unemployment at 15% and we were coming out of the pandemic recession, is that we had so many jobs open that it creates so much more inflation because there was less competition for these wages. So this was a bullish jobs report. It counteracted the JOLTS report yesterday that came in hotter than expected. We had more jobs, which means you have less competition, which means wages have to increase in order to inspire talent to join your company. But that was only 200,000 jobs added. It was like a nothing burger, in my opinion. It wasn't a massive increase in the number of jobs, 9.02 million versus 8.75 million. This was a little bit better, showing we had 43,000 less jobs that were created, which was a good thing, ultimately, for inflation coming down. That's what we had on the macro. Jay Powell will be speaking today, and we'll talk about expectations for Jay Powell in a second, but I expect Jay Powell to be a little bit more bearish, given he's seen the market run to literally all-time highs. And I think he wants everyone to just not get ahead of themselves, given this March cut might not be happening. The 10-year right now at 4.001%, getting a little bit closer to that 3.9 level, potentially, that we were at about 2 weeks ago. And so we'll see if that ends up happening. What time did you guys wake up in the chat? We got 4:40, so I can gym by 5 a.m. before work at 8. I love it. We got 3:30, 6:15, 3 o'clock, 6:30, 8 a.m. Dude, I love early risers. Midwest at 4 a.m. There's something about waking up in the morning and just getting stuff done. It feels amazing. It feels incredible. So that's great. We got some early runners in the chat. 3 a.m. I jogged through the snowy mountains of upstate New York. Okay, that's a different level of commitment to jog in the snow, dude. Like jogging in the cold that's different. Okay, here is Tim Seymour on his expectations for what the Fed is going to do today at 2:30 p.m.
Let's ask founder and CIO of Seymour Asset Management, CNBC fast money trader, Tim Seymour.
Contessa, good to see you.
It is
Speaking of looking pretty damn good.
Thank you.
It's great to be here.
Thank you very much. I assumed that was for me and not
Well,
for the crew.
Ken, I don't know who I walked in as he was saying that, so I thought I'd.
All right, his wife is going to see that tonight, and she's going to be like, oh, so she was looking pretty damn good when he comes home. That's exactly what's going to happen, dude.
Listen, when you think of what the sentiment numbers show for consumers right now, the job market is pretty good. What do the markets want to hear from Fed Chair Powell that they haven't already priced in? Like in what way can he massage his words to say, we're just going to sit right here and wait and see what happens?
Well, I think he's trying to not be dramatic tomorrow. And I think the drama is going to come in the nuance of the Fed statement that finally shows neutrality. They're probably not going to talk about the potential to raise again. They're certainly going to try to, I think, dispel any myths that they're ready to cut, even though obviously that's the big debate here. And I think ultimately markets have the path that they're in, partially because the view is that the Fed is at this point digesting some fantastic inflation numbers. Look at that PCE we got last Friday. A dynamic with the job market that's starting to soften, even though I think we have a great environment.
Here's can we put them back up? This is the Fed rate cut probabilities. There was, and this is from the Fed survey, 9% of those who responded saying, yeah, we think it could happen in March.
Look, it's not going to happen in March. But if you look at where we were a month ago, it was 85% in March. So those dynamics, and I don't think we're going to get 75 basis points by August, which is also what Fed fund futures are telling us right now. But the dynamic with the Fed is something that's allowing equities to move here, because the reality is the Fed, while restrictive and while real rates seem to be going higher, which means that the Fed is actually maybe a little behind the easing curve. That's fine for this market. That's fine for this Fed.
Last year, we heard on air so much armchair quarterbacking about how the Fed was getting it wrong. They were hiking too fast. They were going to put the economy in the tank. When you sit here at the very end of January and look at where we are, do you think they may have gotten it right? Yeah. A soft landing, a Goldilocks.
Yeah, think of the cliches, right? We're threading the needle. We've got the soft landing. It's Goldilocks. It's the triple Lindy for those people who remember Back to School with Rodney Dangerfield.
Yeah.
I know, it's one of your favorites. Look, it's a case where no one believed the Fed could do this. You can't go from 0 to 5.25 in a world, post-Volcker without pain. And in fact, so far, it's been a dynamic where the sequencing of this has actually worked very well with the economy.
Okay, so in an environment where we are no longer hyperventilating over rates and how high they're going to go, the focus has returned to earnings.
Yep.
We got big ones today.
Yep.
What's your sense so far, and where are we going?
Well, unfortunately for
All right. So what he's saying there about what's going to go on with the Fed, I agree with him. The Fed is in a very tough position. Jay Powell right now is not sure what I believe if he's going to do the rate cut in March or not. I think January CPI is going to determine a lot about that. But he is sure that the market has ran up a lot. I mean, all-time highs 3 weeks into the trading year is kind of crazy. And I don't think anyone expected it. And so, maybe some people expected it, but we had targets of 5,200 on the S&P. We're at 491, right? Right now we're at 488 in the pre-markets, but I think we've run very quick. The SMH ETF, the one that Michael Burry was shorting, which I don't know if he's still shorting, but he had like $47 million worth of shorts on that. That's up like 20% in the past 2 weeks or in the past 3 weeks. It's kind of insane, right? The growth that we've had. And I think Jay Powell wants the market to realize, hey, if you don't get the 6 cuts you're looking for, because maybe inflation's stickier than expected, which I think we all agree it's not sticky. But the problem is Jay Powell can't let people believe that he believes it's not sticky. Then the market is getting ahead of itself, assuming there's going to be 6 rate cuts. And you probably don't want 6 rate cuts that quick because then something's broken in the economy. On top of that, speaking of things breaking in the economy, we are seeing a lot of layoffs. I mean, we are seeing a lot of layoffs. PayPal yesterday, after hours, or right before the market closed, they laid off 2,500 people. And then you can see all the layoffs here that has happened over the past month. Google with 1,000, Spotify 17%, Salesforce 700 employees, Unity 1,800, Wayfair 1,650, UPS yesterday at 8 a.m. they announced 12,000 employees. I mean, a lot of layoffs are happening. Now, I know this is tech employees, and a lot of this is not like Main Street America, right? These are not like Detroit auto workers. These are people that theoretically, if you got laid off from Twitch and you were making, $250,000 a year and you were getting stock bonuses to essentially do nothing all day. I'm sorry, but that's just what a lot of these, I'm not trying to be disrespectful, but a lot of these tech jobs you probably don't have to pay that much. You're only paying that much because the tech company is able to afford it because they're a tech company, but you're definitely not doing as much work as like just hard labor as someone else. And maybe your intellectual labor really isn't impacting the bottom line of these companies. And we saw that in 2022, which is why we had massive layoffs. Maybe these layoffs don't massively affect the economy because these are tech workers and they can get other jobs. Remember that girl I showed you guys 2 weeks ago that got laid off from Discord and she live streamed herself getting laid off? She just got a brand deal with LinkedIn. So like I'm sure she's going to probably pull in 6 figures this year just doing like advertisements with LinkedIn because that video got 10 million views. And so she got fired from a fancy tech job that was probably paying her high 6 figures. And now she probably got a high 6-figure brand deal with a tech company, LinkedIn, inside of Microsoft. And so these tech workers, I don't know how much of an impact they're going to have on the broader economy. When we see these layoffs at like Boeing, that's when we've got an issue because that's when the real consumer, in my opinion, is getting affected by these layoffs. Let's take a little bit of coverage on what's going on with layoffs and if AI is actually the reason for this.
Tech sector are mounting. PayPal is the latest company to announce job cuts, slashing around 9% of its global workforce, about 2,500 jobs in all. This follows layoff announcements from Microsoft, Amazon, Alphabet, Block, and eBay, just to name several. Joining us now with whether AI has played a role in these cuts, Alex Kantrowitz, founder of Big Technology and a CNBC contributor. Alex, good to see you.
Great to see you too.
Probably some differences in terms of what's happening at these individual companies. I mean, a PayPal stock's been under a lot of pressure. They're trying to kind of reorient the company. eBay, slowish growth. But then you have the very profitable large winners of tech that seem to be doing this ongoing pruning. What seems to be driving that?
Yeah, totally right. PayPal, that struggles. Google, why are they laying off? What I read from the call yesterday, what you heard Ruth Porat talk about, is that this is a culture thing. They're trying to build faster, and they're finding levels within the companies that's just holding them back. So they need to build faster. They understand they're under.
Basically, the product managers that don't get their Starbucks caramel latte that can't work until 12 p.m. because they don't have their source of caffeine, they're trying to get rid of these people.
Right. This AI thing is real. It's not going away, and they can't have people holding them back. And so what they've been doing over the past year is finding places within the organization that they can trim so that they can get to a pace where they're shipping faster. So taking managers out, and then engineers who are skilled for a previous generation of technology, they're also leaving to make room for people who are more skilled for artificial intelligence.
So making room for other human beings who are skilled in executing the AI strategies, not necessarily somehow their jobs are getting automated.
Oh, definitely. This isn't like a moment where you're starting to see AI replace engineers at Google. Absolutely not. It's more about who can build the new generation of AI technology for us. Let's make room for them, give them room to run within the organization, not be held back by managers who are so skilled in the old technology but are not able to handle the new.
You know, there was a lot of, I mean, on both sides of what Elon Musk.
So those layoffs are happening. And what he was just about to say is that Elon Musk, when he fired 80% of Twitter, that told all these tech companies, yo, like we can really lay off these people. Like it's not that serious to hold them up. I have a personal anecdote. I had a friend who worked at a company. I'm not gonna say the name of the company, but she was a product manager at a bank. And essentially, you know, she told me what her day was like. Her day, she was like, Amit, I'm in Slack all day and I'm basically just sending updates from the engineers to the like management that I have about the product changes they want to get. And I'm just like the intermediary trying to make sure the engineers understand the vision for the product that my management gives me. And so like, that's essentially what product managers do. And I'm oversimplifying it, but that's really what she told me it was. And I asked her, so what is the day-to-day like? And she was like, well, I get paid 120 grand to just like send messages in Slack all day. And it's like, and I'm not saying she's not doing an important job. There's a need for communication between engineers and technical people and like the product business focused people. I get that. That's an important job. That's why product managers exist. But at the end of the day, dude, I can't imagine every product manager is so effective. They're driving so much change that you got to give 100 to 200 grand to these people to sit. I mean, she was telling me that she was going to go fucking get a massage and like go to the salon after she sends her little Slack messages. And I was making a joke. I was like, so you really get paid to kind of just mess around? And she was like, yeah, pretty much. And she ended up getting depressed because of that. And she had to move back with her parents because she got so depressed in some apartment she was paying $3,000 a month for. So there's also a negative downside to that in terms of like, just like how the work really becomes so low quality that you just feel like your life has no purpose. Nonetheless, I think a lot of people would like to make 120 grand for sending Slack messages. So I'm not saying you have to feel bad for her, but that is the state of the economy we are in, given the excessive amount of wealth and opportunity that has been created by these tech companies. And they're realizing, look, maybe the AI can manage the product a little bit better than a product manager. And so that matters. And that is, you know, important to think about when it comes to how companies are thinking of repositioning their workforce. And it brings up a gray area of what are we going to do when these companies are making massive amounts of profits and they're not really sharing it because they don't have to hire that many employees. That's a question for the future, but that is something to think about. We got 3 minutes until the market opens. Let's take a look at equities right before we get into it. This is going to be an interesting one. Google is down because they missed $420 million on their advertising revenue. Ironically, it was $420 million. Tesla's down because Elon Musk got his share compensation package taken back from a Delaware judge that apparently hates him. I did not know, but Chris confirmed today in the chat that she's the one who made him buy Twitter. So maybe she's reading too much Business Insider and and she's just like, you know what? Elon Musk is the worst person on the planet. We're just going to make his life hell. Ironically, if you make someone like him buy Twitter, you're probably someone who doesn't like, you know, the way he's maneuvered Twitter. And to me, he's opened up the floodgates for free speech. I'm very grateful he bought Twitter. So, I mean, it probably went against your interest by making him buy it. But nonetheless, like that is why Tesla's down right now. Google down 5%, Microsoft barely down. Microsoft, I don't know if it'll recover and turn green, but it definitely, you know, is not in the red massively because of their earnings. AMD down about 3.82%. Palantir down 1.64%. We have earnings on Palantir on February 5th. So in about 5 days, it's going to be very exciting to see where Palantir goes. And Microsoft saying the AI spend is there. I would imagine Palantir software business as well. They can hopefully guide for that 25% year-over-year growth. I think Palantir is going to get rewarded for that. But if it's below 20, it's not going to be fun. SoFi, we didn't even get to talk about them. We'll see how they perform. These guys are down 3.45%. So, I mean, I'm really happy I sold my calls. I made some fucking money, dude, because those calls would be worth they would be worth significantly less than if I didn't sell them like 30 seconds into the market open 2 days ago. So SoFi down 3.45%. If it goes down like, you know, another percent, it's basically going to be at levels that it was trading at for the past 2 weeks, which means earnings would have given no share appreciation or like 2 or 3% levels of share appreciation, which sucks. You know, it really does suck. And given what Jay Powell says today, he's probably not going to be the most dovish in my opinion, which means all of fintech, SoFi, Robinhood, PayPal, all of these guys are potentially not going to do well. So, I mean, this is the hard part about owning SoFi. The street does not love this stock yet. They give guidance to be profitable till 2026. Google didn't even give any guidance, and the street's just like, yeah, we don't care. So tough thing for SoFi, but we'll see how they act as the market opens. All right, 9:30 a.m. Wednesday, January 31st. Thank you, everybody, for spending your morning with me. It means the world. Stock market is now open. Wake your ass up. Here we go. Tesla down 2.4% as the market opens, $187. Google, let's get into the big Googs. Google is down 5.27%. Google is down 5.27% on missing their numbers when it came to advertising. So you got Google down right now 5.2%. We got the S&P that's down about 0.45%. That one is down. We've got SoFi down about 2.5%. Palantir down about 1.88%. Robinhood down about 1% down to $10.90. Starbucks, we didn't get to talk about them. We'll talk about them in a couple of minutes. $98. They're up 4%. Quick headline stat for you. Memberships on the Starbucks rewards program are at 34 million. They're up 13 or 14% year over year. I did not even know 34 million people downloaded the Starbucks app and are getting rewards from it. Like that blew my mind away. I did not think coffee was that serious, but apparently coffee is that serious. So that number has got the street excited. They're up 4% right now. Meta 389, they're down because Google's down. The fear is that they missed on their advertising numbers if Google missed. PayPal's down 1.44%. Truist is down 2.33%. It makes sense. Truist ballooned to 38.50 yesterday. If the regional banking ETF is down, JPAL is going to be hawkish today. Truist is going to take a little bit of a beating. So Truist is down. SMCI is down 1.28%, but still above $500. Spotify down 1.73%. Bitcoin also down from 43,800 to 42,000. So it lost $1,000 in the course of a day. Not crazy, but it is down. Pretty much everything is red. Visa's barely green. Celsius is kind of green. By the way, I've been doing a lot more DD on Celsius. Have some thoughts on Celsius. They are more positive thoughts and getting more likely to consider having a small position, if any position in Celsius. But there are some things to think about when it comes to Celsius. So we'll talk about that later. Microsoft just turned green for a second now, down about 0.17%. Google 145. Wow, Google's down 5.7%. Tesla's down 2%. Meet Kevin's PP is down 3.13%. That's because Tesla's down. Coinbase. Let's go to the Bitcoin miners. The Bitcoin miners are down. Look at them. All of them are down. Riot's down 3%. Marathon's down 4%. Hut 8 Mining down 5%. Iris down 5%. MicroStrategy down 1%. CleanSpark down 3%. This bad boy was up almost 10% yesterday. And Bitfarms is down 3.25% as well. Where's Amazon? Let's go to Amazon. Let's see that. Amazon is down 0.3%. They're going to have earnings tomorrow along with Meta. Meta and Apple. All three of them are reporting tomorrow. So tomorrow's going to be another huge earnings day to see what is happening. NASDAQ, where's the NASDAQ? Let's see what the NASDAQ is. NASDAQ is at probably 15.3. Yep, 15.3. So we got NASDAQ at 15.3. S&P is down a little bit, but not a lot. Yeah, down about 0.47%. And then SMH, the semis ETF, I imagine that's down. That's down about 2%. Overall, we're red, but we're not massively red, but we are indeed red. All right, here's the Google position. Let's see how cooked I am on the Google position. I predicted that it would go to $9 a spread, and we are at $9.60. So we're down 3%. So, well, we lost the 3,000 in gains yesterday, and now we're down 3%. So it's not the worst, but we did get cooked. I mean, it is down. So that is the update on the Google position. We are down on Google. So that's where Google is. Where's Microsoft now? Is Microsoft still green or did they go red? Microsoft's green, folks. Microsoft's green. It's up 1%. Look at that. And it's less about it being up 1 or 2%. It's more that the market is willing to buy Microsoft after that earnings. The market is willing to buy. That's the most incredible thing. The market's actually still willing to buy, which is just incredible given, Microsoft's had $3.06 trillion, dude. That's like, and you're willing to buy, it means you think the growth is there. Apple, $2.88 trillion. Microsoft is officially the most valuable company in the world. And you know what? They deserve it because Satya Nadella killed that earnings call. I mean, if there's any company that deserves that type of valuation, it's Microsoft, given the leadership that they have at that company. I mean, it was just an absolutely incredible earnings call, night and day difference from Google. And we'll see what Tim Cook says on Apple. We'll talk about the Vision Pro as well. People got their first Vision Pros yesterday. I firmly believe the Vision Pro is not going to be a product category that ends up taking off, but we'll talk about that in a second. Microsoft's up 4.13 now. Now it's up 1.28%. Google continues to go down. It's recovering a little bit, but it's down 5%. It was down 5.74%. Now 145. Robinhood's down 1.14%. Meta 393. PayPal 62. And then where's SoFi? SoFi's down 3.63%, 10 cents away from hitting the sevens again. 10 cents away from hitting the sevens again. Absolutely incredible. Kevin Smith says, I took a beating on my AMD bet. You're not the only one. I know a couple people that took AMD calls before earnings. Hopefully you just didn't, you didn't lose too much. Down 4% on AMD, 164. The only reason I was afraid of AMD earnings is because, again, the stock's doubled since September. Like a legitimate doubling in the stock. It's not up 20%, 30%. It went from 90 to 180. So at some point, you got to ask yourself, do you think the numbers on a hardware business, they have 52% gross margins. Those are hardware margins, not 82% software margins. Is that enough for the growth to continue after the market already gave it a doubling in valuation? That one felt a little hard. Same thing with NVIDIA, dude. Like, it's hard to buy these stocks. And if we're wrong and it goes to 800, 900, then all right, we missed it. I definitely wouldn't short, but it's also very difficult. I don't know how you stomach buying NVIDIA at these prices. Like, or SMCI or AMD. And like, I could have said that at 300, 400, and I would have been wrong. I get it. But now it's 600. I still think you got to have a thick stomach to just be like, all right, thick stomach makes no sense. But you guys, what I'm trying to say, you got to have a real big appetite to be able to buy those stocks right now. SoFi's in the sevens. SoFi in the seven. Did it drop? Oh my goodness. 802. It is 2 cents. It's probably heading to the sevens. That's incredible, dude. That is absolutely incredible. And it's disgusting. It is just disgusting how the stock is treated by the market. It really is. It really, really is. I mean, this is one of those things when it pumps on earnings, you get the hell out and you buy back in. Because now I could probably get the same calls I bought and do the whole earnings play again for the next earnings. I mean, it's just, and I only did that with SoFi. I don't do that with it's SoFi. I had PTSD from when I was up 30 grand and I didn't sell, and then the 30 grand evaporated within 2 weeks. Like, that leaves a bad taste in your mouth with a stock. And it's just, yeah, there you go. SoFi's in the sevens. When you're up 30 grand and you don't take the profits and then that shit disappears out of nowhere for presumably no reason, nothing. SoFi is beat on every call, expectations, numbers. Now they're profitable. It's just a stock that the street doesn't like. They just don't like. I mean, even Palantir is maintaining the 16s, right? Palantir has not fallen back to 13s in how long? Okay, so last time Palantir was $13, just 13 was July of 2023. I mean, it's been a long time since we've seen those levels, dude. It's been a very long time. Whereas SoFi, it seems like we've seen the sevens, periodically, pretty much every other month. So that is not too bad. Amit secretly loving the SoFi drop. You can tell by the tone of his voice. Think of your sister, Amit. Well, see, that's the thing. I think SoFi will still be $12 by the end of the year. My sister has options. Well, let's look at my sister's options right now. How much are they worth? Oh, by the way, we're in the money on Google. Look at that. Google's at $10.07, $10.20. We're up 3%. We didn't get cooked that bad on Google. We didn't get hit that bad. So, that's my thing. The only reason I'm saying the SoFi thing is because I knew it would drop. And like, if it didn't drop, it's whatever. But I just had a feeling I didn't trust it. Now, granted, long term, I think my sister is going to make 20 to 25 grand because I think SoFi is going to get to $12. And by the end of the year, I think that'll happen. So right now, her position is 10,000. This is pure profit, all of it. She's not up 4,000. She's up a full 10 grand because this is the house's money. We took out her initial capital. So this thing, again, if you simulate the returns, if we just assume SoFi's at 12, just 12, and let's say we don't even sell by the end of the year. Let's say we sell in August, you're looking at 15 grand. And if we just wait till December, you're looking at 22 grand, which is way better than 10 grand. And there's really no risk because worst case, she loses all of this if SoFi goes to $6 by the end of the year, which I just don't think is happening now that they're profitable. I think the risk to reward is very limited here. So, I think SoFi will be $12 by the end of the year. I think we'll have a bull rally towards the end, even if we have some choppiness, and she'll be okay. But in the short term, it's tough. It's tough to see SoFi still be at $7. January 2026, $15 hood calls. I am not opposed to that. Got some juicy DD on hood that I want to bring up in a second, but let me check the open interest on that one. So January 2026, I think there's like at least 5,000 on that one. Open interest, Robinhood, $15 call. There's 4,000. Yeah. I mean, it's not super liquid, but because of that, it might be cheap. Today's a dip day, so it might be a little bit cheaper. You can look at the historical pricing. It's probably down a little bit today, but look, I'm bullish on Robinhood. You guys know that I'm bullish on Robinhood. And so this is what I want to show you guys. So here's my plan on Robinhood. Okay. I have not told you guys how much I have in Robinhood stock because let's just keep that a mystery until earnings. My goal is to take out my initial capital that I put into Robinhood. It's a lot of money after the earnings pump, which I believe will happen. Do not buy Robinhood because you think there's an earnings pump, because I think there's an earnings pump. I believe there's an earnings pump because I legitimately read a couple articles on Robinhood every day, and I'm feeling very bullish, and I think it's going to do well. I think we can get to 13, 14 bucks, but then I think it's going to sell off with the rest of the macro. But I think that is going to be an opportunity, just like SoFi, to make some money. And so do not buy Robinhood. I will say this again, if you don't understand the company, because Robinhood is very speculative. It's very risky. They're barely gap profitable. You really have to understand this company and be okay with understanding it in order to do this. And I don't have short-term expiration options. These are 2026. So let's say worst case, it shits to bed. It'll be okay. Robinhood will be okay. My goal is to get rid of the initial capital on earnings day. And so this is what I found out about Robinhood yesterday. I kind of knew this, but I didn't know this in depth. In September, Robinhood started charging customers 3 cents a contract for options on regulatory fees. Now, I didn't know this, but Robinhood was eating that fee for the past 2 years. Some brokerages like Schwab and Fidelity charge about 65 cents to open or close a contract plus regulatory fees. Robinhood was doing that for free because they wanted to make it like commission-free trading. Obviously, they made it up on the back end with payment for order flow, but they really did not charge that to the consumer. They just didn't want the consumer to pay for that stuff. This is what I got from a Wall Street Journal article yesterday. They were eating these 3%, what are called options regulatory fees and options clearing corporation fees for the past couple years that amounted to 3 cents per contract. That means each contract they trade, they are making 3 cents on more than before. Now you might say, oh, 3 cents is no big deal. They're trading billions and billions of dollars worth of contracts every quarter. And so that 3 cents does add up. I don't think that makes them gap profitable because they are adding a shit ton of customers onto the platform and they're paying a lot in terms of customer acquisition costs with the 1% match and the 3% match on the Roth IRA and the 401k. But that definitely gets them closer to gap profitability. And if somehow they squeeze out profits, if Vlad somehow does it, it's going to be a very good earnings day. I don't think they're going to do it though, but I think the street won't care because they're going to show enough growth in other areas of the business that's going to matter. And then on top of that, you've got them increasing their revenue significantly since they have these 3 cents that are now factored into every contract. So my play on Robinhood is let's take out the initial on the pump. If I take out the initial, remember, I'm reducing my potential for gains. But if I can play with house money for the next 2 years on Robinhood by taking out my initial, I mean, that's pretty cool. And there's a lot of initial. And I'm not going to say how much the initial is, but there's a decent amount of initial. So let's see if we can like double the initial or get like 80% of the initial and then just take out the initial and then just let the rest ride. That is the goal. So we'll see what happens, but we'll, that is the plan for Robinhood and see if we can play that earnings correctly. Where's CleanSpark? CleanSpark right now, look at that, up 0.010%. So CleanSpark is turned from red to green. Microsoft is still green. Google, is it still red? Google is now red 6%. Wow. The street is selling off the stock. They're really not buying the dip. They're really not buying these mother effers are really not buying the dip. They're selling off. That's incredible, dude. That's just incredible. By the way, Kathy Wood. Oh, Robinhood's green now. Oh, wow. Robinhood's green. And then SoFi's probably green. SoFi's 821. So SoFi's down 2%, but SoFi's green as well. That's interesting. Kathy Wood bought 100,000 shares of Robinhood yesterday. She bought 28,000 shares of Tesla, third consecutive day of buying the dip. Tesla, by the way, is at 189. That's recovering a little bit. And she bought 290,000 shares of SoFi. So she loaded up on Hood, Tesla, and SoFi yesterday in order to make some money. So, or in order to get the dip to eventually make some money. So not bad on not bad on Kathy Wood, but it seems like she's the one who's continuing to buy this Tesla dip. And we haven't seen her buy SoFi in a while, so she took advantage of that SoFi dip that we saw. Starbucks is up 2% right now. Meta is down with Google. Google's down 6%. Meta's down 2.49%. I think Meta's going to crush on ad revenue. I think they're not going to miss like Google did. So I think the stock will do fine, but the street is not excited about Meta given Google's numbers. GM is up about 1.67%. They had a pretty good earnings yesterday. Alibaba's at 0.26%. Celsius continues to be down. Disney's at 96. Oh, the Paramount thing. So Paramount's up 12%. Apparently there was a $15 billion buyout offer for Paramount. That is the news on Paramount. Sorry, $14 billion. So Brian Allen, who's like a media mogul, is offering $14 billion to take over Paramount. I mean, that's exciting. I don't know if there's that much value in Paramount, in my opinion. I've looked at Paramount content. I subscribed to Paramount Plus for the free trial like a while ago, and I was just like, none of this is exciting or interesting. But obviously they have enough subscribers where they're willing to pay it. Allen Media Group is offering $21 a share, $21.53 a share for Paramount, which would be $15 billion that they're giving to Paramount for their media group. I mean, look, that's interesting. That's probably going to go through. I don't know who else is buying it. Netflix is definitely not buying it. Netflix is probably happy this is happening. We're seeing streaming continue to consolidate, and we saw Netflix streaming numbers again, 5 million more subscribers than expected. Netflix is the clear winner here. Netflix is not losing here. 30 billion if you include debt. So they're covering the debt. Yeah, so 30 billion. So 15 billion for the actual company, 15 billion in the debt. Yeah, that's the other reason why Paramount's been screwed in their stock. They do have 15 billion in debt. So that is the issue for Paramount. Okay, what else do we have? Paramount's green, that's up 11%. Paramount right now, $9 billion market cap. AMD is down 3%. NVIDIA is down 1.7%. Palantir is down 2.24%. SoFi is down 1.9%, but recovering to 825. So nice recovery on SoFi. We're seeing it at 824. Just bounced up. So the dip got bought up at that 802 range, but still down 2% on the day. PayPal also down 1.3%. Again, PayPal, 2,500 people they laid off, but it was not enough for the street to get excited about that. Hey, Amit, do you have any earnings predictions for PayPal next week? I really don't, because after I tried to predict their Shock the World event, and the only thing was shocked was me seeing that this was a regular video, and seeing that their employees were shocked given that the layoffs were coming. I have no idea what to predict. I would assume transaction margins can start to get higher, and transactions per account will continue to grow at that 12 to 13% year-over-year mark. But I don't have any hope in what's going to happen for PayPal. I think the next quarter, after these 6 innovations they announced go into a play, maybe there you can make some more accurate predictions on what's going to happen to the bottom line. But I do expect them to say they're going to buy back the stock. I do expect them to talk about the layoffs and what that's going to do for net income. And I do expect them to give some level of guidance on transaction margins going higher and growing better than 7 to 8%. Because if they can get to 10 or 11 with transaction margins going to 47 versus 45, I think the street takes it to 85 if they can do those two things. I just don't know if that's going to happen. Not this quarter. And so we'll end up seeing, how it plays out and where it goes from there. Okay, let's get an update right here on the Fed and what we think is going to happen. So here's Bob Diamond talking about what Jay Powell. I'll be live streaming it today, but here's some expectations on what Jay Powell's going to say at 2:30. So Chris, you just said thoughts on Fed rate decisions today. Let's listen to this clip, and then we'll talk about that as well.
Today's Fed decision due this afternoon at 2 p.m. Eastern Time. The central bank is expected to hold rates steady, but investors will be sifting through Chair Powell's comments for clues about when the first rate cut might come. Joining us to talk about the Fed, the economy, markets, insurance, banks, Bob Diamond, Atlas Merchant Capital CEO. Bob, thanks so much for joining us this morning.
Glad to be here, Robert.
So early last year, you were absolutely right. You predicted that there would not be interest rate cuts in 2023. You were right. What are you looking at for 2024?
I think there can be cuts, but I think we have to take it in the context that the economy is actually accelerating. You know, the first half of last year was about 2%. The second half of last year was 4%. I think the Fed is absolutely delighted with where the economy is, where inflation is. And I think if the Fed did cut in the first half of this year and the economy began accelerating more, and worse, if inflation picked up, that's exactly where the Fed does not want to be. So I do think we'll see more neutral language, today. I don't think it'll be hawkish, but I think the expectation of first half cut rates, I think, are ahead of where the Fed would want to be.
But just because the economy is strong doesn't mean that rates aren't restrictive. The real rate, as inflation has come down, is much larger, much higher than it should be. Isn't there room for them to cut even if the economy slows a little bit but is still strong?
I don't think so. I think if the risk for the Fed is, accelerating the growth of the economy and inflation, and I think as you talked about in insurance, not everyone wants rate cuts. So financial services, insurance, as you were just talking about, they're definitely benefiting from higher interest rates.
By the way, a lot of fintech is benefiting from higher interest rates. Robinhood, SoFi with these APYs. The difference is, at least for Robinhood, if the APY, if the Fed funds rate comes down and transaction revenues don't go up, meaning people don't want to, equities don't go up. If rates come down and equities don't go up, Robinhood's in a tough position because then they're losing the incremental net interest income they could get. And so that is the bear case to assume with fintech if rates do come down.
Savers are benefiting from higher interest rates. But most importantly, if you look at the average funds rate since the financial crisis in 2008, it's like 1%. If you look at the average fund rate for decades and decades and decades before that, it's more like 4%. So I don't think they're anxious to cut. I think they're prepared if necessary to cut. And I think they have room to cut, which is really important from a policy point of view.
And that's the other thing. I think they're going to leave themselves the flexibility and room to cut. I mean, Jerome Powell loves that word, flexibility. He's constantly said, we need to be flexible. And I think they're going to give themselves room to be flexible. SMCI somehow is up 4%. I don't know how, but SMCI, people bought the dip. NVIDIA is down 1%. AMD is down 2%. Why is SMCI up 4%? No idea. SMCI, by the way, also, they only have, their margins are about 15%. Now, granted, they're guiding for $14 billion in revenue and the market cap's $30 billion. So they're trading at a, 0.5x multiple on their 1x multiple on their revenue to the market cap. But still, they don't have the best margins. I know they're growing 103% year over year, but I just don't understand how people continue to keep buying the stock at this level. I mean, that's just incredible. Maybe there's an institution that came in and just took a massive position right now. Who knows? Even if it was just a short-term position, but you got SMCI that's up right now, 4%. Here's another news story I want to bring to everybody's attention. And this is in regards to Meta, but outside of Meta, it's also geopolitical. So I like this story because it's not only sort of Meta-based and Google-based to an extent, but it's also geopolitical and what's going on. Maybe geopolitical. We'll see what you guys think if you think it's geopolitical. So we've got a big dispute. Rafi says I'm going full port SMCI right now. Oh boy, that's the whale who's doing it. We've got a big dispute with Universal Music Group and TikTok. Universal Music Group is pulling all of their music from TikTok, or at least that's their plan to do so unless they get to a negotiation. TikTok proposed paying our artists and songwriters at a rate that is a fraction at the rate that is similarly situated social media platforms pay. Today is an indication of how little TikTok compensates artists and songwriters despite its massive and growing user base, rapidly rising advertising revenue, and increasing reliance on music-based content. TikTok accounts for only 1% of our total revenue. Now, why is this super interesting? Number one, this is really good for Meta, okay? Meta, Instagram Reels gets to keep their music. Universal Music Group, keeps licensing the music to Meta, which means on Meta, people can make their little short Instagram Reels. By the way, put in the chat if you're an avid consumer of YouTube Shorts, Instagram Reels, or TikToks. I watch maybe 10 of them a day when I'm when I'm on the toilet, quite frankly. That's really when it happens. But I'm curious, do you actually watch this short form dopamine stuff that the world is like we're basically we're hamsters on a wheel when we're watching this shit. I'm very curious who is a hamster every day on this wheel and for how long, because I know my audience is a little bit older, so I'd be very curious if you guys do this stuff. But a majority of the world does consume content in this way. Okay. So Instagram gets the benefit from the music licensing. YouTube gets the benefit from the music licensing. These pieces of content are basically trash if you don't have the background music underneath them. And Universal Music Group owns Drake's catalog, Taylor Swift's catalog. I mean, they own everything. They own all of the music. So why are they doing this? Their argument to TikTok, and again, this is really good for Meta and Google, in my opinion, because if this actually goes through and you can't watch TikToks with music, people are going to switch to Instagram and YouTube Shorts. I mean, and we're already seeing TikTok's usage decline dramatically. I mean, it's nothing that it was back in 2021 because people have more options and just the app is getting a bit more cringe every day. But in general, Universal Music Group is like, hey, we're not making any money from you guys and we're giving you all of our music. You're using it for free and you're making a shit ton of money off advertising revenue. TikTok's argument, which quite frankly, I'm on the side of TikTok here, is like, mother effer, we are MTV on steroids. In the 1990s, you would be lucky if you can get your music video on MTV. You never had to pay MTV to play your music video because MTV had all the distribution. TikTok is access to the youth that is going to drive up all the streams on Spotify, Apple, and YouTube. So the discovery that TikTok brings to music is unheard of. I mean, it's the greatest music discovery invention of all time. And these record labels are getting free promotion. Literally, it is absolutely free for them to just post a TikTok. And then TikTok's algorithm is just like fire in terms of if you have a good song, it explodes the song. And they're complaining about lack of revenue. This also is a bear case for Spotify. And the reason this is a bear case for Spotify, and this has been my bear thesis on Spotify, even though I think the company is going to grow and I think the stock will do well, but I personally can't invest in the company because I can't overlook this bear thesis. They have no ability to negotiate with the record labels. If the record labels are asking for money from freaking TikTok, where they're getting so much distribution from TikTok in regard to like music discovery and free promotion and marketing, which is 95% of how you make a song work. It could be a crappy song, but it has to get marketed. There is no way in hell, in my opinion, Spotify is going to renegotiate these deals with the record labels in 5 or 10 years and ask them to take less of a cut, because the record labels are going to be like, screw you. We'll give our music exclusively for Justin Bieber from YouTube, and all the little girls that listen to Justin Bieber on Spotify, they'll just go to YouTube. They won't care, because at the end of the day, they want the music. They don't give a shit about the user interface of Spotify. I like, some people will, but a majority of people want the music. Like if you're a Michael Jackson fan, if you're a Stevie Wonder fan, if you're a Taylor Swift fan, you're going where the music is, right? So I think it's really tough for this situation to be in the context of TikTok. I think this is good for Meta. Ultimately, I think they'll come to a deal, but Universal Music is not messing around. I mean, they're just like, hey, if you don't pay us, we're getting out of here. Harry says YouTube Shorts are for college kids with too much time. I agree. When I was in college is when TikTok really started exploding back in 2020. And, you know, I was on that thing all day. Unkid says he watches 2 hours of Reels. Fran says his girlfriend watches 10 hours of TikTok. Byron's wife is addicted to Shorts. It seems like all of you guys and your women are the ones that are actually consuming this stuff, and you guys are watching the long form content on YouTube, getting more educated. IG Reels, we got Austin listening to that. Roy is watching that. Victor says every time I see something from TikTok, it's like, are they dumb? Yeah, dude, I try going on the app, and when I go on the app, it's brainless content consumption. It's literally like my brain is tired of talking about stocks and analyzing the Fed and, you know, looking at stock charts all day. So let me just like watch some nonsense to like entertain me for a second. That's where I'm thinking of. I don't go to TikTok to learn things. And when I try to see someone trying to explain something on TikTok, I'm just like, dude, you have 40 seconds to explain this. I don't like you're just like a hamster on a wheel as a creator and as a consumer, because you're trying to get all this information in 40 seconds. That's why YouTube is Big Daddy, because you need a long amount of time and you develop a relationship with the creator and you're actually able to consume their content and then decide if you want to really, you know, continue watching them. It's just like, to me, YouTube is the king here, which is why they brought in $9 billion of revenue last quarter. TikTok it's just tough. I don't even watch YouTube Shorts, dude. It's tough for me to even watch that. Oh, wow. Hold on. We have a big stream coming on today. Did you guys know this was happening? CEOs of Meta, TikTok, Twitter, Snapchat, and Discord are at a child safety hearing today. When is this happening? I might live stream this today. I don't know when this is happening. It doesn't have a time. Oh, it's happening at 10 a.m. Oh, wow. It's happening in 3 minutes. Interesting. I don't know. Okay, so so they use Zucks in the thumbnail. If Zucks isn't there, we're not going to stream it, because we don't want to hear from like the random C-suite at Facebook talking about, like, I want to hear from Zuck. So if Zuck's not there, there's no point in streaming it. Like, I want to see Zuck's be like, Senator, we sell ads, and then take a sip of his water. That was iconic. If that's not happening, then it's not worth it. Then it's not that fun. But that's going to be a very interesting hearing. So they're talking about child safety hearings. We're going to have to see all these CEOs basically squirm out of their butt cheeks trying to figure out how to tell us why TikTok is not harming the youth, even though we know it's harming the youth. It is what it is, dude. So it'll be interesting to see how Congress gets there. And Congress isn't going to do shit, dude. They're just bored. They're going to get to grill them. AOC is going to try to look like she knows what the hell she's talking about. It's just a circus. It's an absolute circus that goes on in the United States Congress with how they're dealing with tech companies. You know why? Because all the tech companies pay their pockets. They've got a ton of lobbying groups. Like nothing's going to happen. This is just pure entertainment. That's what it is. But if Zucks is not there, it's not going to be that funny. So ex-CEO is there. Linda Yaccarino is very good at not answering questions, so she's not going to be fun to listen to. She's very calculated in terms of how she answers. I've seen her interviews, so I don't know if they're going to get anything out of her. But yeah, we'll see what happens from there. Square them out of their butt cheeks. Yeah, I made that up on the spot, Mark. You know what I said yesterday? Some of you guys missed it at the end of the stream. I said, thanks, Captain Genius. The term is Captain Obvious, and I said Captain Genius in the chat. You guys killed me on that one. You're like, really? Captain Genius. Interesting. Never heard that one before. It's like, yeah, that was what we had. Okay, let's run through some quick macro headlines and then we'll be done for the day. Let's do some quick macro headlines and then we will be done for the day. And then again, guys, I'll be live at what o'clock? I'll be live at 2:25 p.m. I'll be live at 2:25 p.m. and then we will discuss Jay Powell squirm out of his butt cheeks, trying to figure out how to make sure the market doesn't go crazy based on interest rates. Okay, couple headlines. United States mortgage applications declined 7% last week. They were up 4% the week before. So applications to buy a home were down 11.4%, while those to refinance a home increased 1.6%. So refinancing is up. Applications are down, showing a little bit of slowdown in the housing sector. The average contract interest rate for a 30-year fixed rate mortgage with conforming loan balances of $726,000 less was unchanged at 6.78%. So the key headline here is refinancing up, mortgage applications down. 7% is a steep decline. It was up 4% for the third consecutive week in a row last week. This is the first week that it's deaccelerating. So we'll see if this trend continues. But that is something that's down. Italy unemployment rate is down to 7.2%. So good for Italy. That's the lowest in 16 years. That's insane, dude. That's insane. I did like 16 years. That means that America's unemployment is at 3.7%. So it's Italy's had high unemployment, or what I would think is like 8 to 10% unemployment, which is reasonably high for a long time. You've got France's inflation rate came down to 3.1% from 3.7. So we saw a decent decline, 3.7 to 3.1 in France's basically CPI, lowest reading since January 2022. Food inflation. So the baguettes in Paris are cheaper. They are now 5.7% lower than they were in December at 7.2%. And then final headline here, or final two headlines, Brazil's unemployment rate is down 7.4%, down from 7.7%. So we're seeing unemployment go down. And then Hong Kong's annual GDP growth is up 4.3%, up from 4.1%, but below market expectations of 4.7%. So nothing too bad. Nothing too bad in the unemployment sector. Arnie says, win for Italy. I'm included in that unemployment. Shout out to Arnie. Guys, if you have not subscribed to Arnie's Twitter, I'm going to put it in the chat right now. Arnie is indeed unemployed, but it's because he's building his own creator media empire, and he's doing it off the backs of putting out amazing, valuable content. So make sure to check out his Twitter. It's in the chat right now, pounterbolts.com. Amazing Substack. Please make sure to subscribe to his Substack. It's literally free. You get a free update every single week on what's going on with Palantir. He'll be joining me on the live stream Friday or next Monday talking about Palantir. So please make sure to follow him on Twitter. And now he's 100% in Palantir, by the way. He has updated his portfolio to 100% in Palantir. In fact, why don't we bring up that post? Let's bring up that post real quick and actually discuss his logic for doing that. He did that on Monday. So here we go. Let's bring this up right here. This is Arnie 100% in Palantir. Quick 3 reasons. You can read it on his Twitter, but number 1, he thinks there's asymmetry in the price. Palantir is going to grow at 20% year over year. Analysts are severely underestimating AIP. I agree with him. If AIP grows, then 20% CAGR is going to be meaning that, at least on a commercial enterprise level, the stock is cheap, and that if government catches up, then the stock's going to be very cheap. Second, he says the limited operating risk. We got 30% free cash flow margin, which is some of the best in the business. GAAP profitable, $3 billion in cash, recurring revenues from 40 plus industries, healthcare, defense, energy, etc. Healthy financials, a leader in AI. We also understand the market wants AI exposure, and they might not want to pay $3 trillion for Microsoft. So if Palantir is growing at 25%, $60 billion seems relatively cheap compared to Microsoft. And then he says, given the strength of the fundamentals, the worst case I see is a 20 to 30% drawdown, which could lead to a waste of time until the company grows into the valuation. And so that is his thesis. He now has 100% of his portfolio in Palantir. There you go. All right, word of the day. Let's end it off on word of the day, and then we are done. Yesterday, we had an amazing word of the day. It was really fun. Today's word of the day is a little but it's not that exciting. But let's see. Cavil. To raise irritating or trivial objections, find fault unnecessarily. Instead of appreciating the effort put into the event, he chose to cavil about the choice of music. She tends to cavil about grammar mistakes. Okay, so next time your girl is annoying you, cavil. You need to be like, you know what? I feel like you are caviling me with these objections about not doing the dishes when I'm the one bringing money into this household. I'm the one making sure we have a roof over our head. I'm the one making sure that, the economy is doing well because I'm working, okay, woman? So just because I didn't do the dishes doesn't mean you have to cavil against me. And to the women in the chat, same thing to your man, especially if you are also making some money, or you're doing what's probably more important than making money. If you're taking care of the kids, if you got a newborn in the house, that's in my opinion, that matters a lot as well. So if that man can't do some dishes, even though he's had a long 8-hour day, but you're taking care of this kid that's pooping every day and farting and burping and throwing up while they're pooping, then you got to tell your man to stop cavalling you. Okay, you got to tell your man. we got an emoji by Kelly in the chat. You see, I saved myself right now. Just like little Uno reverse switcheroo. It's not just about the men; it's about the women as well. So that's we're equal opportunity jokesters on this live stream. All right, thank you everybody. I'll be live at 2:25. J Powell in the house. We'll see what he has to say. We'll keep going from there, and we'll see if he tanks the market today or if he makes the market turn green. That's it. Thank you, everybody. Appreciate you. I'll see you at 2:25, and we'll be back for the Fed meeting. Bye, everyone. Have a good one. See you in a couple hours.